Most business owners think taxes are about staying compliant, doing the books, paying your bills, and hoping nothing goes wrong. But what if your tax planning could be a springboard to help you grow? In today's episode, we're going beyond the numbers to talk about how founders and operators can stop reacting to taxes and start using accounting as a strategic growth tool. Our guest is Matt Bontrager, founder of TrueBooks, who started his career as a W-2 CPA, seeing firsthand where traditional accounting firms fall short for real-world operators. In 2020, he set out to build something different, an accounting firm to serve founders, not file returns. If you want fewer surprises, better clarity, and a financial partner who actually helps you scale with confidence, this conversation is for you. Let's get into it.
Trying to reach my goals, got no time for mistakes. Yeah, I'm standing on business, need a big safe. Suited up, got the blueprint in the briefcase. It's go time on the grind, needs a big stakes.
Broadcasting from the franchise Sidekick studio, welcome to the Sidekick Life. Get ready for stories of passion, problem solving, and success from those living life on their terms. Hey, welcome back to the Sidekick Life. We are pumped today because we get two benefits for the price of one. We have got CEO founder Matt Bontrager with us. He is the founder and CEO of TrueBooks, a company that we all need to be thinking about working with because it is about reducing our taxes, something that I want to know everything that Matt knows. So Matt, welcome to the show. Happy to have you.
Thanks, Ryan. Thanks, Tyler. I'm pumped to be here.
Yeah, man. So I guess let's just kick it off. I want to hold the tax stuff for the end. We're going to keep that kind of like a carrot for people to stick around for. So I first want to know, tell us about TrueBooks, and then if you don't mind, give us the quick backstory on and how and why you started it.
Yeah. So TrueBooks is my baby. It is a CPA firm. I started it in 2020 with a business partner. And there's about 27 of us now, 26 of us. And we focus on tax and accounting for specifically real estate investors and business owners. And to kind of segue into why I started it, I first just kind of fell into this and am now very grateful to be in this business ownership land. Because I like to tell people I wasn't that kid in school, like slinging candy bars at lunch to make money. I was never an entrepreneur as a kid. Like I feel like most people kind of, claim to fame at that. And, but I was a CPA at a firm, just being a manager. I was W-2'd. And in accounting, you slowly start to build your book of business on the side and grab a client here and a client there. And I had landed a client who at about $2,200 a month was a real estate investor. And I started to do his bookkeeping, and he had a pretty big online presence. And then I had made a comment to him in Q4 of 2019, like, hey, we should start a firm together. You drive the business. I'm the nerd. I'm the licensee. I'll do the work. And hey, it was a beautiful partnership. We kicked that off. And then in 2023, I bought him out. We just had different visions for where the firm wanted to end up. And yeah, so I'm still chugging. And now we just finished our 6th year, going on 7. And so that's kind of how it started. It was just like an idea quickly. And then luckily it's turned into my full-blown profession where, I can feed my kids with it. So I'm pumped.
That's the goal. And I've heard you've got a pretty high profile client as well. Tyler sitting right here on the show with us. So
we do. Yeah. High profile. I was like, oh yeah, where's he going with this? Yeah.
It's been a great relationship. So we've probably been working together for maybe a year and a half at this point. Mm-hmm. And really, I think Ryan, you and I kicked this off because we were talking about future and, to get to the next level. I'm like, I need a really good tax advisor, somebody to really help me. And I think you're like, well, go get him, right? And so go do it. And so you challenged me to go do it. And I did some research, actually a lot of research, about 6 months of research. I interviewed a bunch of firms, came back with Matt. And I'm like, I found my people. And we've been sticking together for, probably about a year and a half or almost 2 years at this point. But it's been a great relationship so far. Fantastic relationship.
You're on the question side now, Tyler. What do you want to ask him?
Oh, let's fire away, man. So my big, my big thing was obviously we've got a lot of W-2 big earners that are coming in. They're like, I'm paying so much in taxes, right? I mean, the tax code is 70,000 pages. And I think a lot of people think of like the tax code and there's only certain things you can do. But why I came to you is you can think outside the box. Like you can take those parameters, those 70,000 pages, and you can find a framework. And that's what you guys did with me. So very consultative in how you approached it. But let's just kick it off. Like what are the big things that people miss, especially business owners? What are the big things that people miss as far as taxes or maybe misconceptions even?
Yeah. First, I would say tax to most people is like this like black box if they don't know what it is. And so what I try to explain to people as a CPA, when should I hire a CPA? I'm a fan of getting a CPA involved once you either run a business or have a rental property. Again, as a real estate guy, I start to see how the tax complexities for somebody, your whole landscape really changes once you have an area of your taxes where you have to tell the IRS what your income and expenses were. That's so different than somebody being a W-2. Like I tell people now, as a CPA, I was using TurboTax and still think TurboTax is a great product for somebody that strictly has government forms issued to them every year, like a W-2, your brokerage statements and things like that. The second you branch into this space where you have a rental property and now you're claiming what your income was and what you were, right, what your expenses were and deductions, or on the business side, what you're making as far as from your vendors and your customers, and then again, your expenses and things like that. So I would say in the overall scheme of things, that is when somebody's tax situation gets complex enough to where I think that they should be hiring a professional like that. And to your point is like, all right, what are like the biggest misconceptions with tax and like really tax strategy? Because that's the thing now. As a young firm owner, I'm 33. I came up with the dinosaurs who ran it as hourly billing. It was, hey, $700 to do Jim's taxes. And then if Jim asks you a few questions throughout the year, you're going to bill him a couple $100, so maybe $900, and then you just ship it out the door. Our firm was built on trying to be strategy first. So for your example, it's like, hey, I'm coming to you not just to prepare my taxes, but help me, one, understand what my situation is and how I can optimize is the word I like to use for my taxes. And so from that point, I think one of the most slept on things is, and this is where any tax talk I do, I always leave with this one core message of good bookkeeping. And I think it's at my core because, and if you think of the name TrueBooks, it was like to be truthful, keep good books. You know, you always hear the term like cooking the books. And it's like so many people, especially again, business owners and rental property investors or real estate investors, they don't take time to keep good accounting records. And as you guys would know, both of you, right, being high up in business, you would see now the value behind having good numbers. Not only are you going to get your taxes done on time, but you're going to be able to tax plan and work to optimize your tax bill. I tell people, if you come to us with messy numbers and your tax bill is $1,000, but then you give me a shoebox full of receipts, now your bill is $1,800 because now I need to have my accountants on the back end go do the work. So one of the most hidden, slept on strategies is simply good bookkeeping because it's an A to Z method of how you keep making better decisions within business and then also keeping better vendors, having better relationships with your tax accountant, you get better strategy. So, and again, that's me as an auditor first. Before I was the tax guy, I did audit, which I think made me a way stronger accountant. Now, I know what to look for in a business to quickly tell if it's profitable, if it's healthy. You know, you look at the balance sheet and then you look at the P&L and then you look at the cash flow statement versus just, learning taxes and how to prepare a tax return. I really take an accounting approach first of having good information so that it leads to, I call that like the foundation, the backbone, so that it leads to better decision-making later. So overall, I'd say good bookkeeping and accounting is just a huge nutcase for it.
Yeah. So for anybody listening here, just my experience, I'll kind of explain a little bit before like why I got to this point with Matt. So I would typically go into my accountant once a year and say, hey, this is what happened. This is what I want to do next year. We'd have a meeting at the beginning of the year. And they would say things like, oh, it's a lot to set up, or like, it could be an audit red flag, or have you thought about this? They weren't really advising me, right? It was like, give me your books. I'm going to do your taxes. That was it. Even when I pushed them on it, hey, I want to meet, every quarter, I want you to go through stuff. I want you to give me a plan. And that wasn't happening at all because we've talked about this. It's a little bit of a liability for them. Like they're not incentivized at all really to do that because they're getting paid no matter what. Right. So when I found you had a very detailed plan of how we can step into the year, all the things we should be doing, which is really what I was looking for. So if you think about that from somebody, let's say somebody doesn't own a business right now. Let's say they are a high income W-2 earner. How would you tell them to take that next step? Obviously, owning a business is huge, but a lot of people are sitting there thinking of this like, hey, I don't have time for it or whatever. But how can they step into a high income W-2 job and also have tax advantages, maybe starting a side business or something like that?
So the side business is great because there is this true, like, we'll call it like inflection point where you hear people talk about like writing off your life. And so what that really means to me, and now seeing thousands of tax returns is yes, if you were to go out and let's just say start a photography business because you enjoy photography, now you can find a way to monetize it and find a couple vendors to pay you or customers to pay you for it. But now that does make the camera, that Canon $4,000 camera you just bought, deductible in full or partially deductible, obviously, if you're still using it for personal and business. But there is this like beautiful bridge between being able to write off things that you are involved in your lifestyle with your business now. The best example I have is I'm big into hobby RC stuff. So the drones, the planes, the cars. I got young kids, so we're mobbing out in the streets every day. And I have a friend that now is an influencer in the RC space, and so luckily I get plugged with good stuff. But those are all write-offs and deductions for him, which if you look at it as it's his full-blown business now for a hobby that, you know, would be someone else's just fun time. But to the W-2 point, so we have a lot of clients in this space which are high earning W-2s, and they're trying to find a way to optimize their tax bill. When I look at tax strategy, I look at it in three core areas. The first, or phases, we'll say. The first phase is reinvesting some of the income you are making back into the activity that you are generating income with. But if you think about it, pause right there. W-2s can't do any of that. If I'm a high-tech W-2 at Google, I can't go spend $200,000 in my salary back into the business and get a deduction for it, obviously. So then you're really out of that first phase of being able to reinvest proceeds back to your business. Then we would move to phase two, which is retirement. Again, I'm 33. I'm building the nest twig by twig. It is incredible to me to see how many people that are late into their 30s, 40s who have nothing in their retirement. And as a real estate guy, I see a lot of people that are banking on the real estate space, which is also fine, but at least they have a few rental properties. But to this topic is like, hey, focus on your retirement accounts. Fund your 401ks, fund your IRAs. I get it. You can't use the money until you're in your 60s, but hey, you're going to still need money at that time. You're getting a deduction for it now. That is good, proper planning for somebody in the W-2 space. Then you shift to this third phase, which is real estate, which is our big, I'll say like that is our stride. That's what our firm focuses on. And what we have a lot of W-2 earners doing right now is they're going into the short-term rental space. And without getting too nerdy, there are a ton of tax rules that disallow somebody making, let's call it $1 million on a W-2 on this side, losing $500,000 on paper. Remember, you're not buying a deal or a real estate deal to lose money on paper. So it's really going to cash flow, but for tax purposes, you are going to lose money. And there are a ton of rules that disallow somebody making $1 million on a W-2, losing $500,000 on the real estate side, and netting those together and paying tax on only $500,000. That is what our firm specializes in. And so to be a little bit more specific, what a lot of W-2 earners are doing right now is they're buying short-term real estate, because to get this net effect, as I just mentioned, with long-term real estate, they're not going to qualify for those rules. Unless you've heard of maybe this real estate professional, hey, I'm the high income earner, my spouse is the one that manages our portfolio, and there is this great dynamic that you can have. But that right there is most likely, if they're coming to us and most of what we work with, they're getting into the real estate space. They're buying short-term rentals to offset the W-2 income, the RSUs that they get, and all that kind of jazz. That's what we would point towards.
Which, Tyler, if I remember correctly, I think that was one of the things that attracted you to Matt in the first place, right?
Yeah, 100%. Yeah. We were pretty focused on that for a while, yes.
Yeah, and Matt, would you say, so, this short-term rental space is something I take advantage of, Tyler takes advantage of, a ton of your clients take advantage of. Prior to that becoming available to offset the W-2 like you had talked about, was there anything that existed like that before? There's always been the challenge of how do you offset W-2 the tax bill. Did you see anything in your history in the CPA world that ever was as effective as short-term rentals? Not as effective. No way. Because, right, the ROI there from the real estate side, because you get to leverage into these deals. So, right, so what I mean by that is, if I'm a business owner and I go buy an $80,000 car, I'm only getting an $80,000 potential deduction. You guys know with real estate, I could put $80,000 down on a $500,000 property, whatever the case would be, and I could get a $100,000 deduction, or I can go put in $50,000 into a, let's just say, partnership that buys apartment deals, and I can get $150,000 back. So as effective, no way. And prior to that, it really is just the focus of retirement until the spouse maybe breaks into the business side of things, to where we, starting to get more normal deductions that way. But no, not as effective. Your hands are really tied when you're W-2'd. Right. Well, and I think there's a misconception also. Take short-term rentals out of it. Let's go back to your original example of being a photographer, right? You've got a W-2, you're making income over here, and you've got this photography business on the side that's losing you money, or at least on paper losing you money. Why is that not as effective? Would you mind explaining to people why that is not as effective as offsetting W-2 as the short-term rentals? As in compared to the photography business? Yeah, why is the photography business not as effective at offsetting W-2 income? For that reason, I think it's mainly because it's about the money spent. So let's take somebody that's earning, let's say, $500,000 W-2, and then the spouse is going to go out and they had this hobby of doing photography, and now they're branching into, hey, I'm a business. I'm going to set up an entity. I'm going to start spending money on some marketing. I'm going to go find customers.
if we think about so I like to be realistic here, right? There's a lot of like just crazy advice going around, but realistically, that spouse, ideally, if they're profitable, are not going to have to put any more money into that business, meaning they probably started that business with, let's call it 2,000 grand in startup fees, or 2,000 grand. Let's just say 2 grand in startup fees, which is your LLC, some office supplies, but let's assume that they already own the camera because they're getting into that business because they already had it as a hobby. So let's call it, even with the cost of the camera, you're less than 10 grand in, cold hard cash wise. With a small business like that, first, let's just say that they go through the entire year and they find 3 grand worth of revenue by hitting up their friends and family as far as who their new customers are. Well, overall, let's just take rough math. If I make 3 grand my first year and I spent 10, great. I lost 7,000. I always tell people, take the L in your first year, especially while you're a small business. Why? Because even that small $7,000 loss, which again, you have 3,000 in revenues, 10,000 in costs, 7,000 in loss, that 7,000 will offset your spouse's W-2. So now instead of making 5, they made 493. But we see that, okay, that's not great. It's going to help and it's going to save us, call it 2 grand in tax or so, which is fine. But it's not that effective, I would say. So the real estate side of things is you can go out and because of the leverage in real estate, meaning I'm taking on debt to buy these big deals, is through cost segregation, which is, again, I'll get as nerdy as you want into it, is when you buy a large asset, you get to depreciate that, right? That piece of equipment or that property or that car over time. And so the best example is you buy a $50,000 car. Every asset with the IRS has a life to it. And so I'm supposed to take that car over 5 years. So let's say 10 a year, 10, 10, 10, 10, 10. But there's something called bonus depreciation where I can suck all of that depreciation to the first year and say, hey, I'd rather take it all now. So I get a $50,000 deduction. And let's say for a car that I put zero money on, we see it all the time, zero money down. So sure, I have a debt payment and now a monthly payment to make on that car, but I get a $50,000 deduction when I didn't put any money down. So if we kind of roll that idea and that concept into real estate, I buy a $500,000 property. I end up getting an $80,000 loss on that property through bonus depreciation of basically me bonusing a piece of that property in the first year. We typically know that the first year you buy a rental property, you're not going to make any money on it, right? The NOI, net operating income, is going to be about zero. So then on my profit and loss statement, when I'm looking at it, I have, okay, my rental income, my property taxes, my mortgage interest, commissions, zero, plus or minus a couple grand. Then I whack it with that $80,000 depreciation expense. Now I'm sitting with a P&L that shows a loss of 80 grand and my W-2 over here. And let's just say for that property, I put down 50. So now I get almost 1.5 times the money that I spent, and it's a much larger deduction. And I can now take that $80,000 and offset the $500,000 W-2. So I would say that's why it's going to be so effective. But I also understand too is, right, and ask Tyler, this is like sometimes, we can show a client how to bring their bill to zero, but that doesn't mean that aligns with what they're trying to do. So like I always make the joke, I can show you how to save 20, but you're going to have to move 60. And sometimes moving 60 is not in the cards for somebody right now because they have something on the horizon that it makes more sense to stack the cash for. So that's why we use this term of like optimizing. Maybe 1 year, it makes sense to build the cash pile up, take less deduction or whatever the case may be, hoard more cash, keep more liquidity for a future deal that comes up. But so to that example, again, you could see how small business, great. You're going to lose money in your first year typically because you're using assets that you already owned and now you get to write them off. But it's not going to be that effective. It's going to be a small number compared to if you really have a high income earner, 300, 400, 500,000. I saw a W-2 the other day for $6 million. I'm like, what in the Lord? It's like monopoly money. But so it happens. CEO. So that's where when you think about it, hey, Honey goes out, just right. She builds this photography business. It's going to be okay. That's not going to really start chipping away at a multi-million-dollar W-2. So you need to start deploying this money into bigger assets that are going to give you a bigger deduction.
I'm such a nerd because the way I look at this is like offense is when you make the money, defense is how you keep the money, right? So it's just you got to play both sides of the game. I hate when people say just make a bunch of money, you're going to be fine. Just you're going to have a big tax bill. It's so frustrating to me because you're leaving so much on the table. So this is how you play defense. Mm-hmm. So let's do the same example for me, and this will be really rough, but somebody buying a franchise. So you use photography business. Let's think about it from like a brick and mortar franchise concept. Let's say it's a golf simulator. You have a build out that's going to be, 500-ish thousand, which is probably a little bit on the high side, but 500,000, you've got equipment, everything depreciates differently. I know this will be really rough. So let's say it's a $500,000 investment. Can you work those numbers real quick at a high level for our audience?
So so let's get a little nerdy here. So one, I'm a big golfer, so I love this. And those things are popping up everywhere around Las Vegas right now, these golf simulators. So just as Tyler said, when you buy into a business like that, you are going to have, let's say a build out is covered by the builder. So let's just assume you're coming in there and actually, no, scrap that. You're coming in there with a shell and you have to furnish the entire thing. Because what I'm trying to get at is, to this point, you are going to be able to, on a $500,000 build, bonus depreciate a lot of those assets. And what I mean by that is, if you looked at a $500,000 spend, you have to break down and compartmentalize what is what. So for context, the room that I'm sitting in, I can't bonus depreciate the structure of the building because the IRS says, hey, that's going to last you a lot of time. We're not going to let you write that off now. That is a 27 and a half or 39-year property. That is the life it was given. But my TrackMan equipment, shout out to TrackMan, I would assume that that's the stuff that somebody would probably put in. Your turf mats, your couches, your TVs, your mounts, your the nice shit that they're putting on the wall and stuff like that, like all of like the dampening for the sound, your snack bar, your vending machines, everything in there. Most of those smaller assets are going to have lives that are 20 years or less. So that is the rule now. If it's 20 years or less, you can potentially bonus depreciate that and suck that forward. So we take this as an example. Let's say $1 million earner on a W-2, they're at Google, they're an exec, and the spouse is like, hey, let's go pop up one of these franchises and start. It's a $500,000 build. Let's say that of that $500,000, $400,000 of that can be bonused, we'll say. This is where every dollar somebody earns is going to fall into one of these two buckets of passive, we'll call it, and non-passive. Non-passive is like your W-2s, your day-to-day income. And what's nice about the example that we're walking through now is when we deal with a real estate client, we are dealing with real estate on this side and business on this side. And that is why there are so many rules that disallow people to do this, because the IRS views real estate as this passive investment. By definition and by nature, it is already default passive. So you're having to jump through all these hoops and hurdles to be able to get this net effect. If somebody goes out and does a franchise, it's even easier because now I'm dealing with, I don't have anything on the passive side. My W-2 is on this side and my franchise is on this side. And so in that example, $1 million W-2, let's say you can bonus depreciate $400,000, but that franchise costs you $20,000 to start up as far as your franchise fees and whatever else. You're getting a $400,000 deduction and loss on paper, and you're bringing that $1 million income down to $600,000 your first year. And right then, usually people ask, well, hey, could I do that across? This is where, if you get people that are amped and they have the firing power and they want to run into this land of entrepreneurship. Could you do that with 2 franchises and make that loss $800,000 and bring that $1 million down to 200? Yes. Could you do it with 3 deals and completely erase them? And I know that I'm just like, at this point, it sounds like some internet troll stuff where I'm like, could you just keep adding and layering? Yes, you could. If the deal is big enough, then you could completely offset the W-2. We see this all the time. That's what our firm does. And you could offset the entire W-2 and then obviously recoup the tax bill. Because last thing on this rant is, just as you said, when you're on offense, that is the earning. That's the income potential. That's where we always tell people, you do have to have a tax problem before you really start working with a CPA. But then when you start, you start to play defense and focus on it, the defense side of it too is also running what your after-tax ROI is. So I'm sure with you guys, when you're walking through these potential deals with people, you're telling them, hey, here's what your cash on cash could be. Here's what you're going to invest in this deal and get back on it, yada, yada. But when you start to factor in what the tax savings are on a loss that you're going to get from the first year, and now instead of cutting on that $1 million W-2, 280 to 350 or really 280 to 400,000, we'll say to the government, look at what you just got back. Let's call it 350,000. Your franchise only cost you 50. Now you're working with $300,000 that you would have otherwise paid to the IRS. So
let's go. You know what?
So hopefully that kind of
I think Tyler had an agenda asking that question, man. You're just selling franchises all day for him. But it's true. I'm glad you were able to nerd out with us and tell us all about that. And, I'm trying to think back. We survey all of our clients and we kind of ask them what's important in business ownership. And I forget the number. I think it was around 25% of our clients last year said they were specifically looking for tax purposes, right? They needed to offset something. So, there's a lot of people out there trying to figure out how this strategy works. So thanks for explaining it.
Yeah, it's very relevant too, because I would assume in most of these franchises, again, with any business like that, you're coming in with some level of deduction that you can likely take a large portion of it that's in excess of the money that you really spent in that first year. And that's where that big tax hit up front can help you. It can basically recoup your investment to get into the deal in the first place.
Hey Sidekicks, it's Ryan Zink here. I'll never forget the moment I opened my first franchise, helping my first customer, hiring my first employee, and cashing my first check. It wasn't just a business, it was the beginning of living life on my terms. When Tyler and I started Franchise Sidekick, we reimagined how people would find brands and succeed in franchise ownership. We're the fastest growing franchise advisory group in the country because we built a smarter, tech-driven system. Our approach has helped people just like you purchase over 10,000 franchise locations, and we've earned a 5-star rating on Google doing it. Now we're sharing exactly how we do it in a quick 20-minute webinar titled 10,000 Locations and Counting, the Franchise Buyer's Blueprint. If you're ready to explore a path to financial freedom and take control over your future, this is your first step. And did I mention, our services are always 100% free. Click the link below to sign up now because you deserve to live life on your terms. We see a lot of people also coming in at the end of the year and it's too late.
Oh, yeah.
Right? By the time they want to research it, buy the brand, buy the equipment, we're like, well, that's going to do you good next year, but it's not going to help you this year.
Yep.
So you just laid out for several minutes, the reason that I would imagine clients work with you because you're very intelligent. You're very, sounds like you understand the best way to save them taxes, which is I think what everybody wants out of their CPAs. I was looking through your material, I think some of your content before this, and one of the things that you guys talk about are kind of like the gaps with traditional CPA or accounting firms. Like, how would you talk a little bit about what you provide versus the gaps that maybe some of our audience is experiencing right now?
Yeah, dude, this one hits home and I like it. I like that I'm 33. I'm really channeled into this profession. I got a banker friend that's always like, anytime I get an idea for something else, he's just like, Matt, shut up and do tax returns. Cause that's where he sees people lose the most money is getting into something else before, a little prematurely. So as a younger practitioner in this space, first, we have to realize that there are 70% of CPAs are set to retire in the next 10 years. And I've probably been saying that for 3 years. So let's call it, there's probably an even higher percentage. We're seeing very low growth as far as students coming into the profession. So for someone like me right now, this is a pure green rush to be in accounting because you have older practitioners that are phasing out. That is honestly our next, once we can get our firm to $8 to $10 million, I'd like to start acquiring other firms because these books of businesses are really just going to dissolve or you're going to get really good payment terms to find these owners. But the traditional model of how a CPA firm was ran was come to Matt meets with Jim. Jim's like, hey, and I see some of these clients because think about it. I partner with a lot of financial advisors. Financial advisors are sending me clients that are older and they're used to working still with this kind of model. So sometimes they get caught very off guard when I'm like, hey, here's what our fees are and here's what our model is in our process. The traditional model was tax guy around the corner. You go to his office, you bring your documents, you schedule an hour or 2 hours, you sit down, you prepare that thing or they prepare it right in front of the client. You kind of talk and say, hey, can you move that? Can you do anything else? Can you, okay, good. We come to a number that we like. And then you pay the guy and then he files your taxes right there. I have never done that once. I've had friends come over and prepare their taxes, but we are such a 180 of a model. What our model is now and what newer models are going to is, post-COVID, I'm a huge FaceTimer and obviously Zoom. So it's much more digital now. So we are meeting with clients digitally. We have an office in Vegas. I love to meet people if they want to come in here, but it's just not that common. So first, what people have to understand is you're not going to prepare your taxes in front of your tax person anymore. That is really phasing out. What's more common is you're going to onboard, you're going to send us your documents, you're going to get access to our portal, you're going to click around and learn the portal where you sign things, where you pay things. And then you're going to send us your docs, we're going to prepare your return, we're going to send it to you, we're going to say, hey, review it, then let's get on the phone and go over it. Okay, we're good, we hit file. So other than from doing it in person to now doing it virtually, that is a major change. When we get more specific into the fees are climbing. I think the average tax prep fee for like a 1040, which is someone's individual return, hovers still in like the 300s. Our average tax return fee at this firm is like $2,200. Why? We're trying to find a higher level clientele that needs planning. And now segueing into planning is, right, because somebody needs to have a more complex situation for me to feel justified in charging them 4X what the price is, 5X what the price is. But that breaks into our first time fees for a client, we want to be between $5,000 and $15,000. Well, why? Because we want to do the planning with you. So just as you guys were talking about earlier is we want to plan and help optimize someone's tax bill. The traditional tax person is you send your documents to Jim. Jim prepares your taxes. You see something on the news or you're talking to a friend at a bar and then you call, your CPA or your accountant and you're like, hey, my friend told me this. Why didn't you tell me I could do this? I would have saved money doing this. And they have this perception that the tax accountant has been having their best interests and every night thinking of strategies to bring their bill down. When in reality, that's never how that firm was built. That firm was built on a transactional relationship. You're doing their tax, they're doing your taxes for $800. You're done. You call them when you need them the next time. What we're trying to do is, hey, clients come into TrueBooks. We do 3 things. We do your compliance, which is filing your taxes, which I would call more transactional. We do your planning, where it's like, hey, you want to be able to ask us questions all year. You want us to like make sure we're on the calendar to optimize your tax bill and put things in front of you to say, hey, do this, this, this to bring it down, at least make you aware, obviously. That's tax planning, which that's the piece that, other people don't do. Older practitioners don't do. And then we do accounting, right? And just normal bookkeeping. So like bean counting. I love that side of the business. And so just that model of service is so radically different. And I'll end with this quick story is I go to dinner with my wife's uncle who runs an investment firm, but also does bookkeeping and taxes. And 30 minutes into dinner and we hit it off great. My wife got us a 6 spot. She works at MGM. So we're sitting over the fountains at Bellagio. He comes in. I'm thinking he's been running this firm for 40 years. He's about to game me up on how to do this better, run my own firm. And 30 minutes in, we're laughing and we're getting along great. And I'm like, I'm just as big as this guy. He's only running a $4 million firm. And then he makes the comment to me. He's like, Matt, I'm making $1 million. And I was like, but then after talking to him, he could be making $1.5 million to $2 million, because what he's doing is he was treating his tax preparation business of doing the tax returns as like the Costco chicken, the loss leader, get him in the door, lose money on that, because what he really cared about was getting the money under management. So he had like an investment, right? Like a financial investment firm. Financial advisory firm. And so what was very interesting to me was I was telling him, like, your entire loss leader is my entire business model, and I'm shooting to make 20 to 30 cents on the dollar. Are we? No, that's just the phase of business we're in. We're growing. But it was just so interesting to me that you had somebody that's been running this firm for 40 years. And I'm like, this is me, 30, 40 years later. He's on the phone all day talking to clients, keeping good relationships, and he has staff that are doing the work for him. But the problem is, what I was telling him is all these phone calls where you're taking them from clients on Saturday or Tuesday at 3:00 to talk to Jim about how to bring his bill down, that is what you're not billing for. And I am being very clear with the client up front saying, hey, do you want this? And if you do, here's the fee. If not, love you. We'll still prepare your taxes, but just know the next time you call me wanting advice or, hey, what should I do here? Should I do this or that? I need to bill you for it, because that is where my value can be heavily provided to you. And so it was very interesting to me to see he's like very happy, 4 million to the top. He's netting $1 million. But he's losing money on the stuff that my entire business is built on. And that also plays into, we do use offshore labor versus other firms are very skeptical of doing that. So yeah, I'm just really enthralled with that question of, and just that topic of how these firms are differing for these younger owners coming up compared to what most people are used to, because those firms are going to be non-existent here in the next 5 to 15 years. They're all selling off to the younger ownership, the younger gen. So yeah.
So one thing you should hit on is why you're different is also your community aspect of it. Like, you have a great community. You get in, I think built on Circle, maybe it's built on something. Yep. But it's fantastic because Matt gets in there. He does like these quick like rundowns. He answers questions. He does webinars in there. It's really cool. So maybe talk on that real quick.
That really has me amped. So I like to be very transparent, as far as the growth of the firm, what we've done last year, we fell 65 grand short of doing $4 million. So this is our third year stuck in this $3 million phase, which I've realized is just war to get out of. But to that topic is, for our business, we try to find what the highest margin service is. So highest margin is going to be tax planning. But the problem with that service is it has the highest churn rate. If a client pays me $5 grand the first year for tax planning, if we did a good job, unless they really plan to keep spending money, keep growing their business, keep building their portfolio, there's a chance they may not need that service the next year. And that's fine. We'll just keep doing their tax prep. But to what Tyler's bringing up is, I think, as a guy that came up in the internet space with all these like gurus pitching stuff, which is just quick offers. Hey, $5 grand for this. And then the thing dies off and they stop servicing it. I try to lead with value, but I also am not blind to the fact that most of the market does not need a tax person where their fee should be 5 to 15 grand because they're a first-time business owner, where I'll say it's not a franchise. Because my argument would be, if you're about to spring 20 plus, 100 plus on a franchise, you need to go hire a good accountant and your fees will be 5 to 20 grand. But if you're just starting a side business, you just bought your first rental property, you just used your camera and now made 30 grand doing photography your first year, you do not need to pay an accountant 5 grand. What you do need is is a one-time upfront quick call to like kind of set you straight with what you need to focus on. So some one-on-one help. But then that one-to-many help, as Tyler said, which we call office hours, where I host 2 calls a month. You can show up and ask questions. And that time is for the people on the call. So yeah, I come into it with an agenda. But if people want to take up 15 minutes to ask a call about their specific situation, by all means, do it. It's a win-win because for me, it is very high margin and it's low input from a professional standpoint on our side. My biggest cost, right? We spend 60 cents on the dollar as far as cost for people, right? My most expensive resource is putting somebody that has a high salary in front of you, just you for an hour, for 2 hours, whatever it is. Versus if I show up to a live call, I can have 200 people and give good advice to people that are within the same boat, and the fee for them is very low. So yeah, our goal with that service this year is to do $250,000 at least. And I just see so many people, like there's one guy specifically, and I'll say his name, Braden Shaw, great community, finance community. You look at someone like that, he's running a school community, 2,600 members, $45 a month. It's like 60 grand a month. And it's just him. And most of it's pre-recorded. So even if you're doing a call a week, a call a month, we found that, and I love to hear it, like, hey, hopefully people are finding it valuable. And my thing is, it's within your price point to where you don't feel gouged up front, where you have to spend all your money on tax planning when you don't even have an income problem. So yeah, we call that office hours. That's more of our digital tax planning. So when I tell people we have 3 tiers of tax planning, first one is digital. You're not getting a lot of one-on-one help. You're in a group. And like a lot of DIY is what I'll say. Level 2 is, hey, you're working with somebody, you have access to somebody, you're meeting with them throughout the year. And then we have that same thing, but just a higher level because we think you're a bigger client. We got to spend more time with you. So maybe we go from, 4 meetings a year to 6 meetings a year. And instead of 30-minute meetings, they're an hour because you just need more help. I'm a big believer on I don't want too many different offers because I feel like then I'm skimping you. And I'm really selling you, like, I'll let you pick something that I really think you need, but it's because you're trying to be fee conscious. And so my thing is like, no, you got to come into the minimum so that I know that you're not going to hate me at the end of the year and you feel like you got what you needed. I try to lead with service. I'm very nervous about tarnishing a brand because now I'm starting to understand like that shit is real. I want to have a good presence online. I don't want to, be one of these internet pop-offs lasted for 5 years and I'm wiped off the face of the earth. So try to lead with the value. And I think that that's a really good, I think a lot more people with high level knowledge should do that model, that one-to-many model.
Yeah, I like it. Look, it sounds like you're differentiating yourself with communication and community. So I got one more idea for you. We're just going to spitball it right here on live.
Yeah.
So, you were talking about your 3 tiers. This is going to be for your higher level client. You ever watched the show Survivor? Remember that show?
Yeah. Yeah, like where they're on the island and stuff. Yeah.
Yeah, where they're on the island and I haven't watched it in a long time, but one of the things I remember about the show is the only way you could win is when you like clan up, right? You got to create your alliance and everybody kind of has their own role. Everybody does their job. And at the end, somebody from that group usually wins. And so this concept I call my Survivor Alliance. So every year I have a phone call with my CPA, my financial advisor, and my trust attorney. And we align on what my goals are for the year. And then I give all 3 of them permission. I say at any time throughout the year, if you 3 want to communicate with each other, you can do it without my approval because I'm a bottleneck. As long as we are all aligned on what our goals are, because if my CPA comes and tells me and I got to go to the advisor, I'm going to get one of the facts wrong and then I got to go back and it's this telephone game versus I just give them permission and it has made my life so much easier. I would never want to have to be involved in these conversations again because of how I was slowing them down. So I don't know how that applies to your business, but if you've got the level of person that needs those 3 and they need them to communicate, one of the things I absolutely love is the fact that they have permission, they know what I want to do and they just run. I get bills. I'll get bills sometimes. I didn't even know that conversation happened. I'm perfectly fine with it because if I ever do dig into it, I find out they saved me a lot more money than it cost me.
That is a great topic. And what's very interesting to that point is, so we're always big on, we would include that in a lower tier advisory. And right now we're recrafting our offers because what we think is the way it was drafted. I mean, just to give a little detail, we thought that a client could get tax planning and only have 2 calls a year. And then we've realized that's not the case because they're just requesting more. We find that they still have questions. So what I believe the minimum needs to be now is you have to meet with a client quarterly, period. So we need to have a fee and a model that can obviously justify that. We can't keep it at the same fee because now we're doing ideally double the work. But we've moved that attribute of being able to communicate with third-party advisors because this is what we would tell them too. We want to meet your money manager. We want to meet your estate attorney because just as you said, I like that you accept it. You are the bottleneck, which is fine. You should be. You're the client. You should just really be telling us what you want to happen and we should be orchestrating on the back end to make it happen and give you action items. And so what we've done is we've moved that because because the problem that we faced is so many people were picking our 4K offer over the 8. And so we've had to really find a way to differentiate the two. We've moved that attribute to the 8. So the only way that we will now communicate with outside teams is if you are a higher level tax planning client. So it's very interesting that you bring that up. And again, it's kind of tough because for somebody that's going to pay the lower ticket, I still think it's helpful for us to do that. But back to a business model, I know that we're going to spend more time doing that. Now I know that I'm not meeting with you 4 to 6 times. I'm meeting with your finance guy. I'm meeting with your estate attorney 2 times a year too. So it's just more time spent. So I love that. I think more people need to focus on that. And honestly, my tip there would be introduce them whether you think it's included in your scope of work or not. Send the email and say, hey, you 3 are very important in my financial picture. I think you guys should meet. And then they're obviously going to know what to do. But yeah, great point there. And that's funny that you're right. You do have to kind of team up to mob against the rest. Yeah, you can't do it alone. Yeah.
Matt, what's the world look like in a few years in the accounting side? If you think about AI, I bring up AI all the time with all of our guests because I'm like, what is it? How does it affect your business? How does it affect accounting?
I would hope that just purely it's going to lead to higher margin, but it's going to obviously weed out people that are doing things a little bit archaic. So right now, I don't know if you guys are seeing it. I think Claude is pumping so much money into just pure guerrilla marketing. The amount of ads that I'm getting hit with just random small influencers. So I think it's like pre-IPO, but it's showing you that there's this big push for AI. We have yet to find something that is that, I don't even know the word that I'm looking for, but that game changing for our business as far as AI goes. Can I put a tax return into certain tax AI tools and it'll spit me out summaries? Great. So for other than like summarizing, helping emails just quickly get a draft ready so you can come in and read it, lower level admin tasks, we have not seen anything like revolutionary. What I'm excited to try here is we're big fans of QuickBooks. So our accounting practice does call it $700,000-800,000 a year. I'd like to really build that practice. That's a great part of the practice. It's obviously monthly recurring revenue. You're doing a great service for clients. You're their backbone system for accounting. And what I think that is, we are slowly starting to try to shift away from QuickBooks Online. I cannot stand that they bump their fees. I feel like every other week they're changing something. And so there's 2 new solutions that are out that are very heavy, like, AI driven and kind of help with analysis for clients and us, like getting them more high level summaries and trends quicker. And also helping categorize the data a little bit quicker. But I answer that to say, hopefully it's going to bring down our cost on labor, period, is what I think it's going to do for our space. Do I think it's going to make accountants obsolete? Hell no. And I obviously pray that it doesn't, but like I would say, my biggest skill set is talking to people. I try to be an honest, candid, sometimes funny if I can, but just an honest guy. And I would say that's my super skill now. And I don't think that AI can take that from me. And so what I would lean on is you're always going to need someone to communicate and sell the client and talk to the client and make them feel comfortable. But the AI is going to help us do the work much more efficiently, to where now instead of having a staff size of 10, you could run a staff size of 4 or 5 with really good tools. So I think it's just going to really bring down your cost of people as far as the firm goes. Your cost of labor, instead of 50 to 60 cents on the dollar, is going to drop to maybe 30 to 45 cents, right? Like depending on how effective you get. Yeah.
That's good. Matt, something that's cool about your story is, you check a couple of boxes that are important on something that we do, or at least that we preach. Like, we want to be a bridge from people to go from W-2 to business ownership to life on their terms, right? And one of the things that I talk or write about is how oftentimes the best way to do that is to start as a minority partner in a company. Mm-hmm. And the second is to do whatever it is that you're doing as a W-2 and turning it into a business, right? Kind of perfecting your craft on somebody else's dime. And then eventually, I just think it's such an easy path. Do what you know with who you know, just find a way to do it better. And it sounds like maybe your story kind of took that journey, right? You were a CPA, you had a client that you ended up partnering with. Would you mind just talking a little bit about how did you, I think you said you're 33 now, you've been doing it for 6 years. So you were 27 years old, so still pretty fresh as a CPA. How did you convince a real estate investor to take you on as a partner and start this?
Yeah. Oh, that's such a good question. It kind of gives me goosebumps too, because it was, again, I was not this entrepreneur type. I had my first son at the time that was like 3 months old. My wife had a W-2, was holding it down. I tell people that I found a lot of comfort in growing my, like, moonlighting on the side and growing that small book of business, so that I knew that if I left the W-2, got fired for, like, let's just say that they fired me for working on the side, whatever the case was, I at least had some income on the side to be able to rely on. But to the point of how I felt confident in selling that service to the investor, luckily enough, it was something that I knew like the back of my hand from the time that I'd spent in the business and actually going to school. I take a lot of pride in going to school for what I actually do day to day. I know there's a lot of people with degrees that are like, I don't even use it. I use mine every single day. And what he needed was, he had posted online on Instagram for a bookkeeper. And I'm like, dude, I will do this with my eyes closed. Like, hey, right. And I'm an investor myself. So it was something that luckily the skill set that I had that I was earning a paycheck for was posted online, and I directly, could do that myself. I didn't need to rely on anybody else to do it. I knew the software that I had to use. But that was it. Just as you said, I just had the skill set to be able to fulfill what he was needing. And at that point, like I said, I think my book of business was 40 or 50 grand in tax returns. He was 2,200 a month, and then landed that, and then made the, comment, maybe this is 6 months later that we should start it. And yeah, quit my job December of 19, started Jan 2020. So yeah, it was really just the skill set of having that skill set. Yeah. Which kind of ties into what I was doing. It was, hey, I wanted to go into finance. I got a job at Wells Fargo at the bank. I thought that was so cool. Got a good internship. When you're at school, they preach, hey, if you're an accountant, you got to go to the Big Four. Went to the Big Four. Loved it. And I got my way there through talking. I was not the best student. The first question, so what's funny is there's a partner that got transferred to a new engagement that my wife knew. And so-and-so was on this engagement. And I was like, my first interview was with her. And the first question she asked me was, hey, why is your GPA so low? I'm like, oh, fuck. Like, I was so thrown off. It was the first thing she asked me. But I told her, I was like, hey, I'm just not the best student, but I'm a hard worker. And so I showed up to every event in a suit and, got my way there. And when I left, everybody wanted to talk to me because I had that resume builder. So I just think grinding it out and becoming good at a skill set. And that's now as somebody, I have, 3 young kids. I got a 6-year-old and twin 4-year-olds. I find it so fascinating is to find out what they're good at, because now as the dad that grew up and now they can look at their dad as a business owner, and that's kind of what put them through school. I'm like, relax kids. I didn't have this. I didn't think I was going to do this. And now I would think that as much as I would love them to do it, I now realize you have to have a skill. You have to have something that's of value to other people. And so I'm just, now I kind of get worried about them. I'm like, oh my God, what are my kids going to be good at? So I don't know. But luckily they're so young. I feel like I got time. I'm a little premature to that. Yeah.
Hey, speaking of kids, my son, he's taking career skills in school. And I said, what are they teaching you? And the first thing he said they taught you is if you have a low GPA, don't put it on your resume. So, maybe you should have taken career skills back then.
That's awesome. Hey, I got a quick question for you, kind of random, but one of my favorite parts about being an advisor at Sidekick is the fact that I get to talk to some really successful entrepreneurs. And when you do that, you start to see there's certain similarities, right? So what are the similarities that you see with your high net worth individuals or people who are super successful? What are they doing?
They ask a lot more questions. That's something that I, as a spaz myself, I'm starting to realize in leadership and just becoming a better businessman is instead of talking so much, they ask a lot of questions. In times that I can catch myself in a conversation, maybe talking or monologuing for 2 to 3 minutes, that same person would have asked maybe 5 or 6 more questions, getting more information from that person. I went and did the career, which was, kind of like a full circle moment of, I got to go back to UNLV where I graduated for a career night. We had a booth there for TrueBooks, and I'm right next to these people that, I was looking to be hired by, and talking to some of these students, you could quickly tell kind of who has that grit and who doesn't. People that wouldn't even make eye contact with you. They would shake your hand and kind of look around. And I think people are really losing those interpersonal skills. And I'm going to take it to the grave that that's what got me here was my people skills. And so I think that that's what I've noticed in high level entrepreneurs and successful people is they are pretty good at talking to people and communicating at least what they need. So whether you're whether you really like to sit there and small talk or not, or whether that's a skill of yours, they are really clear and effectively communicating what they want, what they need, what their desired outcome is. Whether you can meet that or not, it at least gets you guys to the same page for you to be able to rebuttal and try to set a different standard. So I just find them to be good, good, clear communicators. They're organized people. That's why for us is sometimes it's tough because you have somebody willing to pay 10 grand to work with us. And then we get into their situation and they're a mess and they're not listening to what you're talking to them about. And somehow that always comes back to you. It's our problem, which I kind of agree. It was my problem to bring you on as a client because I should have caught it up front that you weren't going to listen kind of thing. So I would say organization, good people skills, and good listening skills. They're really, just really good communicators and organized is what I'd say.
We've all lived the life of an entrepreneur and we've seen the benefits of it and also the struggle of being an entrepreneur, right? There's the good and the bad of it. In fact, before this show started, we were all kind of swapping stories on some of the challenges of entrepreneurship. But Matt, I want to ask you this question because I want our audience who are currently W-2s thinking about being entrepreneurs to hear your answer is imagine 6 years ago, you never teamed up and started TrueBooks. You're still a CPA. You're still working for whatever firm you worked for. Tell me about your life. What's your life like compared to what your life is like now as an entrepreneur?
I'll start off with saying I would go back and make 50 grand before I went to go work for someone else again, because here's what it would be. We would never have got to spend so much time, especially during COVID, with our kids, right? Our kids are still so young. Being able to have flex. I don't know how people work full-time jobs, 8 to 10 hours a day, and not have to pick their kids up, or, I would be making less money. I know for a fact. I would, as weird as this sounds, the schedule would, no, and actually no, because I was going to say I'd be working more, and I wouldn't, obviously. I work 24/7 basically, but what I tell people now is I'm a roamer. So I'm on my phone. When I'm in the car, if I'm Ubering, I can take phone calls walking into lunch somewhere. When I'm at home and my kids are, I don't know, maybe they're doing something outside and I'm not with them, I can sit there and float on my computer at the counter for a minute. So I like the flexibility of being able to roam around and work. I would completely lose that and, probably isolate my workday to more of that 9 to 5. Just obviously in accounting, you are working normal business hours. And I don't think that we'd be able to do the types of oh my God, dude, you're sending me on a rabbit hole. We couldn't do half the stuff that we do now. You wouldn't have the income and you wouldn't have the time. Like my kids take golf, right? Like, so I'm a big golfer. Now I have, all my kids are in golf. That's Friday at 3:30. Who's going to do that? So my life would be dramatically different. And that's where I go back to this saying of like, I would make an eighth, a sixth, a fourth of the income that I make, because now I just truly see the value in, you need to run your own schedule. If that's something that really matters to you and you're growing a family, I don't know how people really do it without it. But this is where I like to humble myself and think there's somebody now 3 miles away living in an apartment with 5 kids and they're thugging it out. So that's where I also just try to have that like Andy Frisella, just like don't whine about it mentality. And it just really just level sets you to be super grateful that you've been able to design a lifestyle like that.
That's design is such a great word, because I was about to talk, obviously you got to do hard stuff, very hard stuff at times. And I guarantee, I didn't even ask you the question, but I know you wouldn't trade it for going back to work for anybody else. And I think for those people that are listening to this, they're in their W-2, and even the folks that work with us, we give an exit interview when they decide not to buy a business, a franchise. And there's 2 reasons that people usually don't buy one. One is funding, right? They can't go get the funding, and it is what it is. They come back later when they can. Or 2, fear. And oftentimes they don't say it's fear. They say it's change of circumstances or, something else happened. But we all know that really is just kind of a code word for fear. And, hearing your story and hearing many other people that we've had on this show, it's like, it's hard. It's really hard to be an entrepreneur. You're going to go through even the period, I forget what you called it, but you're in like this revenue period right now that is so hard to break out of. And it's going to feel like it's forever. And it's going to feel like, am I ever going to get to the end? Yet all of the challenges, all of the hard stuff, all of it is so much better than the W-2 that you had previously for somebody else. Mm-hmm. So for those people that are backing away because of fear, I will tell you, as long as you're willing to roll up your sleeves, I think for 5 years, do anything hard for 5 years, maybe 10 really, to get that exit value in it, and your life is going to be different forever. So thanks for sharing that story. I think that's important for our people to hear.
No, yeah, thank you. Yeah. Like I said, I feel like business is war. Every day you show up and it is hard, but when you really sit back and think about what it has afforded me or what it could afford, just anybody running their own business, their own shop, big or small, you could have 2 employees, you can have 25, you can have 100. It's incredible to see the kind of life that you can design from that. And that's where I'm so grateful that I just somehow inched into this, because again, I didn't grow up thinking I would run a business. That wasn't my thing. I followed exactly what I was told. Go to school, get a degree, get a good job. And I did those things. It's just sort of checklist items. So it just happened to be like a good break, and I got an opportunity and took it. And that's where, to your point, is I do make the joke that luckily I feel like if all of this crashed and burned, could I go make $250 at an accounting or finance role somewhere? Yes. And that brings me a lot of comfort. Because now, to these people that are maybe nervous, if you are truly confident in your skill set and now you're even entertaining getting into something else, have that thought in the back of your mind that, just as you said, hey, you can give this 5 years of try, right, or of effort, and then still be able to go back on that skill set that you still have. So, that's interesting, the exit interview thing, because now you've really just got to somebody at the very end, and now it's, hey, let's talk about why not.
This is kind of the last one on my mind, but I know you're not a financial advisor, but you're kind of a cousin to a financial advisor. You all play in the same space, right? And you said you have 3 kids?
3 kids.
3 kids. And I know they're young, but tell us a little bit about what your advice is going to be to them. First, when they're young around investing, and then second, when they get out, past school, what you hope they do.
So what's funny is we just had this whole topic of we go to the bank. I bring the kids into the bank. Terrible move. That lasted about 6 minutes. And then, my wife sat there with the banker and I had to go outside and let them run around. But we just set up bank accounts because what I quickly wanted to realize is this is how dumb I am. They get the piggy banks at home. We're putting coins in them. I myself, at some point, tried to count the coins and the dollars with my 6-year-old, write it on a sticky note. And then I was thinking every time we added money to it, I'll adjust the sticky note. How dumb is that? But I'm like, hey, at least he shows you I'm an OG accountant. So then I'm like, all right, we need to go get bank accounts. And we get bank accounts. And then I quickly realized I'm like, this is dumb too, because all you have is a checking account. I have no way to differentiate saving. And that is now to this topic of what I really want to lean into the 6-year-old. First is earning and then saving. He's super interested now in how he can earn money. Now we can get into the parenting talk of like, I'm not paying you to pick up your room. That is what you need to do as a member of the household in your own space. But if there is a common area, like for context, I gave my daughter $1 to scrub down the garage door. This is a common use area. Someone's got to do it. Could I make you do it as a chore? Sure. But in this, 2 weeks of, hey, we just set up bank accounts. Money is the big topic. I want to show you guys what it is like to earn. And so I would say what I really want to emphasize with them is the earning and being creative and how you can earn money, because that is, to be honest, what my biggest fear is for them. As somebody that now I'm like, oh, great, I run a business, but I'm like, oh my God, I did not think I was going to do this. It would really scare me if I had to go out and start selling something new. I love this business because if I, do Tyler's taxes and he's happy, hopefully we stay together for 20 years, right? And I can do his taxes for that long. So being able to provide value over and over again and find new opportunities for it is something that I want them to learn. But 2 is the savings component. So that's why we scrapped the bank accounts. And I don't know if you guys have heard of, we went to this app called Greenlight, killer. It's so we set up that and now showing them, hey, if you make $10, peel off 20, 30% of it so that he can start to understand what it's like to watch a number grow, but also be able to peel some off and go to Target and, spend $8, $12 on a toy. So, earning and saving is what I would really focus on, because now I see people into their 30s that have zero money in their retirement. And I'm like, even if that number said $18,432, that's a lot of money. And you could have easily gotten to that had you started in your early 20s, just slowly, chiseling away at that. But people don't, they forget about that compound effect and how long, how much time goes on that you could have just been peeling off money and saving it. But they think about that. I don't know what they think about, but that is something that I would really want to hone in on for my kids. Saving.
I love it. By the way, Greenlight's my favorite app. I'm in it every day with my kids. Yeah.
I'm still new to it, but like my understanding is you can buy stocks with it. So I'm talking to another dad and the dad's like, yeah, he likes Elon. So we bought a share and so. I'm like, oh, that's so sick. Cause now they can get on and understand that concept of investing and growing the money, which I find people now in their 20s, 30s and 40s still don't really understand that. And I'm like, oh my God, can't be my kids.
Right. And it's just muscle memory too, because when they start young, all of a sudden it's not this foreign thing they got to figure out later on their own. They're doing it with you next to them, explaining it to them. They're putting 10, 20, $100 in whenever they get birthday money, whatever that is. And now my oldest, my 16-year-old, he's been in that app now for like 4 years, and we look at his 4-year return and he can't believe it. He's like, I've made more money in 4 years than my friends have with jobs. And I'm like, that's because you started early, and you're disciplined.
Yes.
Yeah.
I just did ours last night. So we have a chart they fill out every single night for getting how the whole thing works. But basically they fill it out, they get money for it. And then half goes savings, half goes into investing, or half goes to spending, half goes into investing. So last night chart completed. I think they each got like $85 for the month, half and half. And they pick their stocks and the rest of it they can spend. And it works super, super well, man. So
crazy how adults don't focus on that. And again, it just baffles me. But hey,
mine's big on creation. So I encourage them. I give them $4 per hour of creation. So basically, if they're creating videos or whatever it is, creation over consumption is what we call it. And so if they're doing that kind of stuff, then they get paid for it. So they can be doing Legos and they get paid for it.
Yeah, that was a big topic that somebody was explaining to me, just the disproportionate size of creators versus consumers. And that is wild when you really run down that rabbit hole, which just shows you almost just need to swing the bat and move yourself to that creator bucket. And there's so much opportunity that will come from that, whether you think you are good or bad at it. It is just bound to happen because of that disproportionate size. So
the number one core value of our family is creation over consumption, because it's just such a disease right now.
It's really good. Matt, man, you've covered a lot with us today, and I know we're kind of coming up to the end here. So 2 questions. One, is there anything you wish we had covered that we didn't, anything that you want people to know about you? And second is, how can people find you and TrueBooks?
No, I mean, again, thank you guys for letting us kind of veer off between business ownership and taxes, because I feel like right early on, it was a lot of the tax, like, hey, how can I save money on taxes? But now I feel like I've been running this business for 30 years and it's only been 6. And so I really enjoy, as much of a struggle it's been, what I'm learning through running a business. And so again, I like to talk about that and share that, right? Because it is, I would almost say it's kind of isolating. You don't have a lot of people to talk about that with. There's just not a lot of people that run businesses or people that I hang around with. So that was nice. And then two, how you can find me. I mean, Instagram is still big. I'm online, posting content and things like that. And it's just my name at Matt Bontrager. Got a YouTube channel too. Same thing, Matt Bontrager. But And if you wanted to find us, our website is truebookscpa.com. I tried to buy truebooks.com, but it's owned by Kelly Blue Book and they want $1 million. And I'm like, I'm not doing that. So
someday,
someday maybe. But truebookscpa.com. And those are the outlets.
It's good. T-Mobile owns Sidekick.com. They haven't given me a price yet, but someday for us too, right?
Really? What? From the phone? It's got
the old Sidekick phone. Yeah, that's
no
right.
price yet, huh?
No problem. Well, technically it's not their fault. I haven't asked. I've been nervous to hear what it is. So, Matt, this has been awesome. Tyler, really appreciate you making the introduction, and we want regular check-ins on how things are going with Matt and TrueBooks. Sounds like it's right up your alley.
Love it. I appreciate you guys. Cool. Thank you.
All right, you bet. Thanks for joining us. Thanks for joining us on the Sidekick Life, where we highlight true sidekicks, entrepreneurs who've got their customers' backs, solve real-world problems, and after helping enough people, get to live the life they've always dreamed of. We'll see you next time.